Korea had been misleading the world, claiming it had enough money to withstand the crisis. The IMF's Stanley Fischer arrived in Seoul to inspect the central bank's accounts.
I visited Korea a couple of days before they turned to the IMF for help, and there was a state of panic. And it was at that point that I went to the central bank and was shown how much money was left in the Korean central bank. It was essentially all gone.
Korea was about to default on its loans from Japanese and Western banks. Pressured by their governments, the banks agreed to share some of the pain. They rolled over their loans. Korea was then given the largest bailout in history.
If they had done that in Thailand, I think that they would have not only avoided some economic problems, but I think that the sense in Southeast Asia that the Americans were really on the side of putting things right would have been stronger.
Then a very, very strange thing happened. From about the 1st of February 1998 until August, there was a period in which financial markets essentially decided that risk didn't exist anywhere.
Markets thought contagion had been contained in Asia. Investment flowed elsewhere. Some came to Russia, where the Moscow stock market was the best performing in the world. But economic reforms had stalled, and Russia was heavily in debt. Even so, investors were convinced they'd found an emerging market that couldn't fail.
Investors had decided Russia is an ex-superpower. It has lots of missiles and lots of atomic warheads for them. Certainly you could not have a financial accident in Russia because the rest of the world, the rich countries, would bail Russia out. Well, it turned out that that was wrong.
Russia defaulted on its debt. Its currency plummeted. Global investors were stunned.
All these people who in the previous 7 months had decided there was no risk anywhere literally panicked and decided there's got to be massive risk everywhere. Behind each fence and barnyard wall, there must be a risk that we hadn't thought of, kind of like the redcoats retreating from Lexington.
Everywhere, markets were freezing up. The economic crisis seemed to have taken on a life of its own.
I thought at the time that I had a pretty good sense of what was going on, but what I didn't know, and nobody could possibly have known, was not what was going on at the moment that you were looking at, but what was going to happen at the next moment.
Well, when you get in a room with both Alan Greenspan and Robert Rubin and they say they're scared to death, and they've never seen anything like this, and they're worried about whether or not we can get through it. I get worried because they know a heck of a lot more about it than I do. You had the contagion sweeping across all the developing countries. As Rubin said, we've never seen that before. I mean, maybe in the Depression they saw that over a period of time, but nothing that happened that quickly.
Now the crisis had reached America. A little-known but powerful private investment fund was on the brink of bankruptcy. Long-Term Capital Management, or LTCM, directly controlled $100 billion of global assets and indirectly more than $1 trillion.
The 90s saw a huge buildup in concentrations that we had never seen on a global scale. Maybe we had way back in history. Maybe the Romans had financial institutions that were disproportionately large to the overall activity of the world that they operated in. But LTCM was a specific type of hedge fund. They were involved, whether it was the Singapore Exchange, the Tokyo Stock Exchange, the London Stock Exchange, the New York. There was no market that they weren't maybe the largest player or close to the largest player.
By September 1998, LTCM's losses were spiraling out of control. Contagion had arrived on Wall Street. Incredibly, the failure of this single investment fund threatened the entire global economy.
If LTCM went down, it would be just the gears, the machine just stopping, the economy not working. And of course, it's not just what's on the balance sheet of banks and so forth, but that would translate into people not working, businesses not operating, small businesses not being able to get the capital they need, and this a global economy that almost inconceivable to see what the picture, but sort of just not working, and people just not working.
The New York Federal Reserve summoned representatives of major U.S. and European banks to an urgent meeting. John Corzine, then at Goldman Sachs, was among them.
The real problem with long-term capital was nobody really understood all the downsides. All one knew was it was going to be extraordinarily dangerous to enter into that. And everybody, I think, understood the Fed's concern that that had real implications to the real economy.
Since LTCM was a private fund, the government could not impose a solution. The fate of the global economy was in the hands of these bankers.
The head of a securities firm or a bank is not paid to be a patriot. He or she is paid to serve the best interests of the shareholders. So the most that one can do in a position like mine is to say the public interest may well be served by long-term capital management not failing. But there is no public sector money to solve the problem. The taxpayer is not going to do this. You folks have to decide whether it's in your interest to do it.
The banks agreed to put up their own money to rescue LTCM. Wall Street had averted disaster, but the global crisis had one final chapter to go. What had started in Asia now reached Brazil, the 8th largest economy in the world. But this time, a loan package was put in place early. Brazil's government cut spending and enacted reforms. It worked. Brazil's problems were contained. Global financial markets gradually returned to normal.
It's not clear when you would say it ended, but what happened was that the countries that actually took ownership of reform, Korea, Thailand, Brazil, began to reestablish stability in their financial markets, and their economies started to recover. And after a while, there came a point we began to feel maybe we're past the crisis. Then a little bit past that, we said, it does look like we are past the crisis. And finally, we got to the point where we said, well, we think this is over.
The world economy had survived the first crisis of the globalization era. But millions of ordinary people had paid the price.
And that's the unfortunate part of so-called globalization, because such negative effects can come very fast. It takes decades for a country to grow up, and all of a sudden it disappears.
We've been a poor country, so we never tasted richness. When we tasted the richness, we wanted more, being greedy. I blame myself also. Never had enough.
Quite a view.
Yeah, it's quite a view, and I really feel bad because no one can enjoy it now. It's all left to the bank. And here I see a nice fairway, a nice lake. It's so sad. Sandwich ไหมครับสิริวัฒน์ sandwich ไหมครับสิริวัฒน์ sandwich ไหมครับสวัสดีครับสิริวัฒน์ sandwich ไหมครับ I had a big dream. I couldn't achieve it. And that's why today standing selling things for 2 hours and you don't sell anything, or you sell very seldom sell. But after 4 years of struggling, at least I know I have a chance. Today my big dream is to be McDonald's of Thailand, because selling sandwiches on the streets, now I develop a new Japanese sushi. I use Thai brown rice. I'm the first in Thailand. So hopefully in the near future, I will raise my funds in the local stock market. So in the near future, I will be McDonald's of Thailand.
The global economy rested on institutions that dated back to the end of the Second World War. The Contagion crisis proved that the new era of globalization needed new rules.
We have to improve the rules of the game. You want the financial system essentially to be like the shock absorber in a car. When you hit a pothole, yes, this car still bounces. But have you ever been in one that didn't have a shock absorber? If you have a good, strong shock absorber, at least you get through the pothole and you're still driving in the same direction that you thought you were when you hit it.
The moral is that there are risks to globalization, but in the end there's no alternative to globalization. So don't let your banks lend recklessly, don't allow bubbles to get out of hand, keep prudent measures, sound economic policies which will inspire confidence and maintain confidence, so in a crisis people will know that you will stay the course and won't panic and be up and off. It's easier said than done, but these are the principles you have to follow.
We had a close call, and without an activist international policy, you could have seen perhaps as serious an economic downturn as we'd seen any time since the Great Depression. And that's why we need to continue to understand the dynamics of financial crisis better, and that's why especially the United States needs to be prepared to take a lead in working to contain financial crises.